Welcome to The Explainer. Today we are tackling something huge, IFRS 17. It's the new accounting standard that completely changed the game for the entire multi-trillion-dollar insurance industry. It sounds complicated, I know, but trust me, we're going to break it all down.
So, to really get why IFRS 17 is such a big deal, we have to look at the problem it was built to solve. And I think the best way to do that is to start with a question.
You know, if you were an investor just a few years ago, trying to figure out which of two insurance companies was doing better, it was a total nightmare. And the reason for that all came down to the old accounting standard, IFRS 4. It wasn't really a full, robust standard, more like a temporary patch that created a system that was, well, all over the place. Under that old system, IFRS 4, insurers basically used this patchwork of local accounting rules. It was like trying to compare apples and oranges. You'd have one company in Germany reporting one way, another in South Africa reporting a totally different way. One might book all its profit the second it sold a policy, while another would spread it out. IFRS 17 just sweeps all of that away and creates one single global standard for everyone to follow. Yeah, that global mess and total lack of comparability is exactly why the people who set these rules decided to create a single global answer. And that answer is IFRS 17. At its core, the goal here is actually pretty simple and, honestly, powerful. The standard itself says it's all about providing information that faithfully represents the contracts. All that really means is it's trying to give investors, analysts, really anyone, a true, clear, and consistent look at how an insurance company is actually doing financially. And let me tell you, this change did not happen overnight, not even close. We're talking about a journey that took nearly 2 decades. It started with that temporary fix, IFRS 4, way back in 2004, and IFRS 17 didn't actually go live until 2023. This was a marathon, for sure, not a sprint. Okay, so how does this new standard actually work? Let's get into the nuts and bolts. It's really built on 3 main ideas. What the standard calls its building blocks. The first block is called fulfillment cash flows. This is basically the insurer's best guess about the future. They have to map out every single dollar they expect to get from premiums for a bunch of contracts, and then subtract every dollar they think they'll have to pay out in claims. It's the core calculation of the promise they've made to their policyholders. Next, on top of that, they add a risk adjustment. I mean, nobody can predict the future perfectly, right? So that first estimate is never going to be 100% accurate. The risk adjustment is a buffer for that uncertainty. You can think of it as the price the company puts on taking on unpredictable stuff, like what if a storm is way worse than expected, or what if people start living way longer than our models predict. And third, this is the really revolutionary part, the contractual service margin, or CSM for short. This is the total profit an insurer expects to make from a group of policies over their entire life. But, and this is the absolute key, it's unearned profit. And that little detail completely changes how companies report their profitability. So how does this whole CSM thing actually work? Well, instead of letting an insurer book all its profit on day one, IFRS 17 says, nope, not so fast. It forces them to treat that expected profit like a piggy bank. It sits on the balance sheet as a liability, and then, as the insurer provides coverage, year after year, a little piece of that profit gets released into the income statement. For the first time, profit is truly earned as the service is delivered. Okay, that makes sense for profitable contracts, but it brings up a really important question. What happens when an insurer sells a policy that they pretty much know is going to lose money right from the get-go? IFRS 17 has a very, very strict rule for these. They're called onerous contracts. And under this rule, there is absolutely no hiding. If a group of contracts is expected to be a money loser from day one, the company can't just smooth it over or hope it gets better. They have to take the hit. They have to recognize the entire expected loss immediately, right there in their income statement. This is just a massive leap forward for transparency. So, as you can probably guess, these fundamental changes to how things are measured completely transform what an insurer's financial statements look like. This right here is the real aha moment for anyone who looks at these reports. Those old terms we were all used to, like written premiums, they're gone. They're replaced with new lines that give a much, much clearer idea of how an insurer is actually making its money. And this leads us to the single biggest win for transparency. For the first time ever, the financial statements clearly separate the profit an insurer makes from its main job, providing insurance, from the profit it makes by investing all the premiums it collects. You can now see clear as day how good they are at underwriting versus how good they are at investing. It's a clean split. All right, let's zoom out for a second and talk about the bigger picture. Who does this actually apply to, and why should it matter to everyone, not just the accountants? So, this new standard casts a really wide net. It covers pretty much everything you think of as insurance and reinsurance, but it also very specifically carves out a few things, like the warranty on your new phone or employee benefit plans. Those things are covered by other accounting standards. And there is some good news here for the sake of simplicity. For short-term contracts, think your annual car insurance or home insurance policy, IFRS 17 allows for a much simpler way of doing the books. It's called the premium allocation approach, or PAA. It helps avoid some of the really heavy-duty complexity for those more straightforward short-term policies.
So let's tie it all together. Why does any of this matter? It really is a game changer. For investors, it means you can finally compare companies from different parts of the world on a true like-for-like basis. For everyone else, it just means way more transparency into where the profits are really coming from. And that helps everybody make better, smarter decisions.
Ultimately, what IFRS 17 gives us is this powerful new lens to look at the entire industry. It's not just about who's growing the fastest anymore. It's about the quality and the sustainability of the profits they're making. And that leaves us with a really fascinating question to think about. Now that we can see everything so clearly, which kinds of insurance business models are actually going to prove to be the most resilient?